Speculation. Most market transactions involve buying things that exist, based on whatever value they have to the buyer and whatever price is charged by the seller. Some transactions, however, involve buying things that do not yet exist or whose value has yet to be determined, or both. For example, the price of stock in the internet company Amazon.com rose for years before the company made its first dollar of profits. People were obviously speculating that the company would eventually make profits, or that others would keep bidding up the price of its stock, so that the initial stockholder could sell the stock for a profit, whether or not Amazon.com itself ever made a profit. Amazon.com was founded in 1994. After years of operating at a loss, it finally made its first profit in 2001. Exploring for oil is another costly speculation, since millions of dollars may be spent before discovering whether there is, in fact, any oil at all where the exploration is taking place, much less whether there is enough oil to repay the money spent. Many other things are bought in hopes of future earnings, which may or may not materialize. Scripts for movies that may never be made, pictures painted by artists who may or may not become famous someday, and foreign currencies that may go up in value over time, but which could just as easily go down. Speculation, as an economic activity, may be engaged in by people in all walks of life, but there are also professional speculators for whom this is their whole career. One of the professional speculators' main roles is in relieving other people from having to speculate as part of their regular economic activity, such as farming, for example, where both the weather during the growing season and the prices at harvest time are unpredictable. Put differently, risk is inherent in all aspects of human life. Speculation is one way of having some people specialize in bearing these risks for a price. For such transactions to take place, the cost of the risk being transferred from whoever initially bears that risk must be greater than what is charged by whoever agrees to take on the risk. At the same time, the cost to whoever takes on that risk must be less than the price charged. In other words, the risk must be reduced by this transfer in order for the transfer to make sense to both parties. The reason for the speculator's lower cost may be more sophisticated methods of assessing risk, a larger amount of capital available to ride out short-run losses, or because the number and variety of the speculator's risks lowers his overall risk. No speculator can expect to avoid losses on particular speculations, but so long as the gains exceed the losses over time, speculation can be a viable business. The other party to the transaction must also benefit from the net reduction of risk. When an American wheat farmer in Idaho or Nebraska is getting ready to plant his crop, he has no way of knowing what the price of wheat will be when the crop is harvested. That depends on innumerable other wheat farmers, not only in the United States, but as far away as Russia or Argentina. If the wheat crop fails in Russia or Argentina, the world price of wheat will shoot up because of supply and demand, causing American wheat farmers to get very high prices for their crop. But if there are bumper crops of wheat in Russia and Argentina, there may be more wheat on the world market than anybody can use, with the excess having to go into expensive storage facilities. That will cause the world price of wheat to plummet, so that the American farmer may have little to show for all his work, and may be lucky to avoid taking a loss on the year. Meanwhile, he and his family will have to live on their savings or borrow from whatever sources will lend to them. In order to avoid having to speculate like this, the farmer may in effect pay a professional speculator to carry the risk, while the farmer sticks to farming. The speculator signs contracts to buy or sell at prices fixed in advance for goods to be delivered at some future date. This shifts the risk of the activity from the person engaging in it, such as the wheat farmer in this case, to someone who is, in effect, betting that he can guess the future prices better than the other person, and has the financial resources to ride out the inevitable wrong bets in order to make a net profit overall because of the bets that turn out better. Speculation is often misunderstood as being the same as gambling, when in fact it is the opposite of gambling. What gambling involves, whether in games of chance or in actions like playing Russian roulette, is creating a risk that would otherwise not exist in order to profit or to exhibit one's skill or lack of fear. What economic speculation involves is coping with an inherent risk in such a way as to minimize it and leave it to be borne by whoever is best equipped to bear it. When a commodity speculator offers to buy wheat that has not yet been planted, that makes it easier for a farmer to plant wheat without having to wonder what the market price will be like later at harvest time. A futures contract guarantees the seller a specified price in advance, regardless of what the market price may turn out to be at the time of delivery. This separates farming from economic speculation, allowing each to be done by different people who specialize in different economic activities. The speculator uses his knowledge of the market and of economic and statistical analysis to try to arrive at a better guess than the farmer may be able to make, and thus is able to offer a price that the farmer will consider an attractive alternative to waiting to sell at whatever price happens to prevail in the market at harvest time. Although speculators seldom make a profit on every transaction, they must come out ahead in the long run in order to stay in business. Their profit depends on paying the farmer a price that is lower on average than the price which actually emerges at harvest time. The farmer also knows this, of course. In effect, the farmer is paying the speculator for carrying the risk, just as one pays an insurance company. As with other goods and services, the question may be raised as to whether the service rendered is worth the price charged. At the individual level, each farmer can decide for himself whether the deal is worth it. Each speculator must, of course, bid against other speculators, as each farmer must compete with other farmers, whether in making futures contracts or in selling at harvest time. From the standpoint of the economy as a whole, competition determines what the price will be and therefore what the speculator's profit will be. If that profit exceeds what it takes to entice investors to risk their money in this volatile field, more investments will flow into this segment of the market until competition drives profits down to a level that just compensates the expenses, efforts, and risks. Competition is visibly frantic among speculators who shout out their offers and bids in commodity exchanges. Prices fluctuate from moment to moment, and a 5-minute delay in making a deal can mean the difference between profits and losses. Even a modest-sized firm engaging in commodity speculation can gain or lose hundreds of thousands of dollars in a single day, and huge corporations can gain or lose millions in a few hours. Commodity markets are not just for big businesses or even for farmers in technologically advanced countries. A New York Times dispatch from India reported, "At least once a day in this village of 2,500 people, Ravi Shyam Chowdhury turns on the computer in his front room and logs into the website of the Chicago Board of Trade. He has the dirt of a farmer under his fingernails and pecks slowly at the keys, but he knows what he wants: the prices for soybean commodity futures." This was not an isolated case. As of 2003, there were 3,000 organizations in India, putting as many as 1.8 million Indian farmers in touch with the world's commodity markets. The farmer just mentioned served as an agent for fellow farmers in surrounding villages. As one sign of how fast such internet commodity information is spreading, Mr. Chowdhury earned $300 the previous year from this activity that is incidental to his farming, but now earned that much in 1 month. That is a very significant sum in a poor country like India. Agricultural commodities are not the only ones in which commodity traders speculate. One of the most dramatic examples of what can happen with commodity speculation involved the rise and fall of silver prices in 1980. Silver was selling at $6 an ounce in early 1979, but skyrocketed to a high of $50.05 an ounce by early 1980. However, this price began a decline that reached $21.62 on March the 26th. Then, in just one day, that price was cut by more than half to $10.80. In the process, the billionaire Hunt brothers, who were speculating heavily in silver, lost more than $1 billion within a few weeks. Speculation is one of the financially riskiest activities for the individual speculator, though it reduces risks for the economy as a whole. Speculation may be engaged in by people who are not normally thought of as speculators. As far back as the 1870s, a food processing company headed by Henry Heinz signed contracts to buy cucumbers from farmers at pre-arranged prices, regardless of what the market prices might be when the cucumbers were harvested. Then, as now, those farmers who did not sign future contracts with anyone were necessarily engaging in speculations about prices at harvest time, whether or not they thought of themselves as speculators. Incidentally, the deal proved to be disastrous for Heinz when there was a bumper crop of cucumbers, well beyond what he expected or could afford to buy, forcing him into bankruptcy. It took him years to recover financially and start over, eventually founding the H.J. Heinz Company that continues to exist today. Because risk is the whole reason for speculation in the first place, being wrong is a common experience, though being wrong too often means facing financial extinction. Predictions, even by very knowledgeable people, can be wrong by vast amounts. The distinguished British magazine, The Economist, predicted in March 1999 that the price of a barrel of oil was heading down, when in fact it headed up. And by December, oil was selling for 5 times the price suggested by The Economist. In the United States, predictions about inflation by the Federal Reserve System have more than once turned out to be wrong, and the Congressional Budget Office has likewise predicted that a new tax law would bring in more tax revenue, when in fact tax revenues fell instead of rising. And in other cases, the CBO predicted falling revenues from a new tax law, when in fact revenues rose. Future contracts are made for delivery of gold, oil, soybeans, foreign currencies, and many other things at some price fixed in advance for delivery on a future date. Commodity speculation is only one kind of speculation. People also speculate in real estate, corporate stocks, or other things. The full cost of risk is not the only amount of money involved. The full cost of risk is not only the amount of money involved. It is also the worry that hangs over the individual while waiting to see what happens. A farmer may expect to get $1,000 a ton for his crop, but also knows that it could turn out to be $500 a ton or $1,500. If a speculator offers to guarantee to buy his crop at $900 a ton, that price may look good if it spares the farmer months of sleepless nights, wondering how he's going to support his family if the harvest price leaves him too little to cover his cost of growing the crop. Not only may the speculator be better equipped financially to deal with being wrong, he may be better equipped psychologically, since the kind of people who worry a lot do not usually go into commodity speculation. A commodity speculator I knew had one year when his business was operating at a loss going into December, but things changed so much in December that he still ended up with a profit for the year, to his surprise as much as anyone else's. This is not an occupation for the faint of heart. Economic speculation is another way of allocating scarce resources, in this case, knowledge. Neither the speculator nor the farmer knows what the prices will be when the crop is harvested. But the speculator happens to have more knowledge of markets and of economic and statistical analysis than the farmer, just as the farmer has more knowledge of how to grow the crop. My commodity speculator friend admitted that he had never actually seen a soybean and had no idea what they looked like. even though he had probably bought and sold millions of dollars worth of soybeans over the years. He simply transferred ownership of his soybeans on paper to soybean buyers at harvest time, without ever taking physical possession of them from the farmer. He was not really in the soybean business. He was in the risk management business.